What can I gain from Warren Buffett's investment advice, as expressed by the man himself? Have you ever pondered the idea of having surplus money and wondered, life is good, but what do I do with all this extra cash? Chances are, such thoughts are rare. A universal desire among people is to maximize wealth with minimal effort. Individuals like Warren Buffett, currently ranked as the fourth richest person globally, make amassing wealth through the stock market seem deceptively easy. The fundamental concept appears straightforward: buy low and sell high. However, the reality of getting rich through stock market investments is more complex than it appears. Fortunately, Buffett has provided some valuable insights. When he established Buffett Partnership, Limited in 1956, he began crafting reports for his partner. These reports delved into his perspectives on the market, future predictions, and his investment principles. While navigating the market remains challenging, Buffett's wisdom, encapsulated in 14 years of his accessible and humor-infused letters, serves as a comprehensive guide for anyone aspiring to enter the world of stocks. With a bit of luck and, more importantly, consistent effort, you might even find yourself on the path to wealth. In the following summaries, you will discover why acquiring the Mona Lisa was not a sound financial decision for France, how Warren Buffett unintentionally engaged in his first arbitrage deal, why patience emerges as the paramount virtue for investors of all kinds. Exercise patience, as deliberate investing, rather than frenzied speculation, is more likely to yield value. There exists a fundamental Wall Street secret, responsible for Warren Buffett accumulating an $88.9 billion fortune. Ready to uncover it? The central message is to exercise patience. Opting for careful investment, as opposed to impulsive speculation, is more likely to result in the creation of value. Investing may not be as complex as rocket science, but there's a caveat. Many people mistakenly interchange speculation with investment, yet there's a clear distinction. Speculators closely track unpredictable market fluctuations, engaging in rapid buying and selling of stocks with hopes of quick riches. Investors, on the contrary, make informed decisions to buy businesses after a thorough evaluation of their intrinsic value and then adopt a waiting game. Warren Buffett, the renowned billionaire, is emblematic of an investor. Though he attended business school in New York, his roots lie in the Midwest, and his systematic, straightforward approach defines his letters and overall investment philosophy. Inspired by his mentor Ben Graham, Buffett recognized that the prices of most financial assets, such as stocks, eventually align with their intrinsic values. When you purchase a stock, you're essentially acquiring a small stake in a business. Over time, the stock price adjusts to reflect the business's performance. Strong profits lead to an increase in business value and share prices. Conversely, if the business loses value, due to a scandal, for instance, the share price drops. Occasionally, a stock's price doesn't accurately mirror the business's value. Investors who invest in undervalued companies and patiently wait for the market to rectify itself invariably profit. The crucial aspect is focusing on what the market should do, not when it should do it. Trusting that the market price will eventually align with the actual value of a business enables eventual profitability, discouraging premature selling during market downturns. This patience rewards investors with compound interest, a pivotal driver of value in long-term investments. Compound interest involves continually reinvesting gains so that each new cent generates its own returns. Einstein famously dubbed compound interest the eighth wonder of the world, emphasizing that those who comprehend it earn, while those who don't, pay. Buffett's favorite illustrative story on the potency of compound interest revolves around the French government's acquisition of the Mona Lisa. King Francis I paid $20,000 for the painting in 1540. If he had invested the money at a 6% compound interest rate, France would have amassed $1 quadrillion by 1964. Convinced of the potential of investing? In the upcoming summaries, you'll discover how to cultivate your unique investment style. Successful investors share a common trait: they are relentless measurers. Warren Buffett, known for his unwavering confidence in investing, even viewed the Dow Jones Industrial Average as his primary competition when he was a relatively inexperienced fund manager. His sole objective was to outpace the market and grow his fund at a faster rate than the famous New York Stock Index. However, achieving this was more challenging than it initially seemed. The main point emphasized here is that all prosperous investors share a fundamental practice: they compulsively measure their progress. Comparing the stress of checking one's bank balance after a lavish weekend or stepping on the scale while attempting to lose weight, many individuals may find the anxiety of potential failure overwhelming. Yet, to thrive as an investor in the Warren Buffett mold, one must overcome such anxieties. Success in investing requires meticulous measurement, clear analysis, and a steadfast approach, even during downturns. Here's some more straightforward advice in Buffett's style. The harsh reality is that most people lack the acumen to outperform the market. Buffett himself considered achieving returns exceeding 7% annually a significant accomplishment. However, the magic of compound interest means that surpassing the market by a small margin holds the potential for substantial financial gains. Knowing what metrics to measure and executing the process diligently is the only way to gauge whether you are on the right path. So, how does one compulsively measure? It involves daily monitoring of investments, tracking their performance relative to past results, and maintaining composure during challenging times. This approach demands energy, commitment, and honesty, knowing when to persevere and when to cut losses. However, the evaluation isn't solely against past performance. Each year's results should also be measured against the overall market. If the market experiences a downturn and your losses are slightly less, it still counts as a victory. There's positive news as well. Buffett, in his early investing days, faced a more formidable challenge in outperforming the market compared to the present scenario. The introduction of index funds in 1975 has made it easier. Index funds, which combine portions of various companies on a given stock exchange, broadly mirror the market's gains and losses. Buffett advises those lacking the time or energy for active investment management to opt for index funds. Otherwise, compulsive measuring remains the sole method for assessing your investment progress. Young investors should concentrate on acquiring shares in undervalued companies, a category Warren Buffett refers to as generals. After mastering the art of measurement, aspiring investors can begin shaping their unique investment style. It's crucial to recognize that each investor is distinct, and their approach should mirror their personality, objectives, financial resources, and, most importantly, their skill set. If, for instance, you're an alpaca rancher, attempting to amass wealth through computer chips might not align with your expertise. Here's another positive note for new investors with limited funds. They possess an advantage over those managing substantial portfolios. This advantage stems from the ability to invest in smaller, non-listed companies, which can yield significant percentage gains. As your investment portfolio grows, the necessity for larger deals to impact overall results becomes apparent. Warren Buffett's early investment success, starting with just over $100,000 in 1956 and growing to $1,900,000 by 1960, was attributed to his focus on small, seemingly unremarkable investments. The fundamental message remains: young investors should direct their attention to purchasing shares in undervalued companies, termed generals, by Buffett. In addition to his patient disposition, Buffett's greatest strength as an investor lies in his ability to assess a company's value. In the initial years, he favored investing in generals, defined as fair businesses at wonderful prices. These companies, though of moderate quality, were priced below their market value for various reasons. Buffett's patience paid off, with most generals remaining in his portfolio for extended periods. Buffett also favored shares in companies with a higher value in liquidation than as a going concern. This way, if a business faltered, he could liquidate it without incurring losses. Such businesses are referred to as net nets. While ultra-cheap stocks and net nets may lack glamour, Buffett humorously termed them his cigar butts. Reflecting on his investment career after 12 years, he acknowledged that this investment category had delivered the best average returns. As Buffett's success grew, his definition of value evolved. He shifted from merely considering cheap stock prices to assessing the quality of a business and the sustainability of its earnings. With increased experience, he transitioned from buying fair businesses at wonderful prices to acquiring wonderful businesses at fair prices. For more seasoned investors contemplating involvement in the management of their investments, Buffett suggests proceeding but emphasizes the need for additional guidelines, which will be explored in the following section. Taking on more risk in familiar markets can potentially result in greater rewards. During his childhood, Warren Buffett would purchase a 25-cent six-pack of Coca-Cola from his grandfather's store and sell individual bottles to his friends for a nickel each. This venture carried a degree of risk. If the neighborhood kids weren't thirsty that day, he would be left with unsold bottles. However, on successful days, he could earn a 20% profit on each six-pack. The central message conveyed here is that assuming more risk in markets you are well acquainted with can lead to increased reward potential. Unbeknownst to him at the time, Buffett's 25-cent Coca-Cola deal represented his initial foray into arbitrage. He was capitalizing on the price disparity for a single product, Coca-Cola, in two different markets, the store and the neighborhood kids. Arbitrage involves betting on what you believe a company will be worth in the near future. Returns on arbitrage bets can be highly lucrative, but success requires an intimate knowledge of the businesses and their respective markets. When the product in question is a share in a company, it is termed merger arbitrage. Buffett excelled in merger arbs during his early investing years, purchasing stock in a company at one price with the expectation that its value would increase post-merger with another company. While the returns on merger arbs may be tempting, the associated risks can be significant, making it a challenging strategy for the average investor. Unless the deal falls within your specialized field and you've thoroughly studied it, it's generally advisable to steer clear. For seasoned investors not interested in navigating the complexities of merger arbs, there's an alternative known as controls, a term coined by Buffett. This involves acquiring a substantial enough stake in a publicly listed company to wield influence over its operations. However, such deals may lead to tense confrontations between company owners and new board members advocating for substantial operational changes. Early in his career, Buffett faced criticism for these deals, believing he was salvaging companies by eliminating inefficiencies. Over time, he distanced himself from controls, recognizing the potential messiness and discomfort associated with layoffs or firings. Despite this shift, Buffett's core investment principles have remained steadfast. The upcoming discussion will delve into why his steady-handed approach has been instrumental in his remarkable investment success. While your strategies in the market may adapt to changing conditions, it is crucial to maintain unwavering core principles. Although following the crowd is often a sensible approach, especially when people are fleeing from something unseen, this tactic can be problematic in investing. The majority, by definition, cannot outperform the average. To succeed as an investor, it is essential to train yourself to go against the prevailing trend. Warren Buffett's investment philosophy underscores a critical principle: only invest when you fully comprehend the entire scenario and the optimal course of action. In all other instances, it is advisable to abstain, even if the majority appears to be making profits. Buffett has consistently been a cautious investor. In 1956, when he initiated his career as a professional investor, the stock market was deemed excessively high. Despite expectations of a correction, stocks continued to rise. Rather than deviating from his strategy, Buffett adhered to his ultra-conservative approach, anticipating an eventual correction without certainty about when it would occur. Meanwhile, other investors, like Jerry Tsai in New York, were capitalizing on the public's growing appetite for speculation. Tsai's approach contrasted sharply with Buffett's. He engaged in frequent buying and selling of stocks based on market fluctuations. While Psy's strategy initially yielded impressive returns, Buffett remained skeptical of its sustainability. In 1966, as the market reached a new high, Buffett took decisive action. He stopped accepting new partners and halved his performance goal. Despite this adjustment, his fund continued to perform exceptionally well, reaching a peak in 1968 with a 58.8% return. However, Buffett recognized the need to exit the market before the inevitable crash. In contrast, Psy, though foreseeing the impending end, sold his fund just in time in 1968. In the early 1970s, the Dow experienced a significant crash, and Buffett's net worth remained unscathed because he had withdrawn all his money from the market. Psy narrowly avoided disaster, but his investors suffered a substantial 90% loss of their portfolio assets. Buffett's steadfast commitment to his convictions serves as a valuable lesson for all investors, emphasizing the importance of identifying one's beliefs and making substantial bets when the right opportunity arises. This approach minimizes the risk of substantial losses. In summary, the core message is clear. Succeeding in the stock market is achievable for anyone, but it requires dedication, time, and a serious commitment. By adopting Buffett's advice on meticulous measurement, steadfast consistency, and, above all, patience, anyone has the potential to evolve into a prosperous investor. Thank you for joining us on this rewarding journey of knowledge and inspiration. If you found value in the insights we've shared and are eager for more wisdom from impactful books, we encourage you to back our channel. Notably, a substantial number of our listeners haven't subscribed yet, so we kindly ask you to consider hitting the like, share, and subscribe buttons to stay linked with one of the leading book summary channels online. Subscribing ensures a steady stream of uplifting and thought-provoking summaries, keeping you involved and inspired. Your support is pivotal, and in return, we pledge to consistently provide high-quality book summaries in a timely fashion. Let's persist in this pursuit of growth and enlightenment together. Wishing you joyful reading, continuous learning, and ongoing personal development.